Welcome back, Focus learners, to another deep dive here on The Explainer. Today, we're decoding market strength. We're going to uncover the hidden language of crypto charts and strip away all that noise to look at the actual mechanics of buyer and seller participation. If you've ever looked at a crypto chart and felt like you were only getting half the story, well, you were probably right. Today, we're giving you the other half. Picture this scenario for a second. You log into your exchange and you see two different coins. Both of them just jumped precisely 10% in a single day. They've got the exact same price move and they even share the exact same shape on the candlestick chart. But here's the catch. One of them is a real sustainable breakout that might keep pushing up for weeks. The other? It's a total illusion and it could collapse right back down to zero in a matter of hours. So how in the world do you tell the difference? The reality is, the price chart alone just can't tell you which breakout is real. It's mathematically impossible. But our ultimate detective tool, trading volume, absolutely can. This metric acts as a literal lie detector for the market. Serious, profitable traders never ever look at price without also checking the volume. It is the secret ingredient that turns a blind guess into a highly educated thesis. Let's jump right into part 1, defining crypto trading volume. Okay, let's dive into this. To truly understand market momentum, we have to define our core metric first. At its most basic level, trading volume is simply the total amount of a cryptocurrency that gets bought and sold within a specific period. On almost all platforms out there, the default window you're going to see is the 24-hour volume. Here's the absolute easiest way to internalize this. Price tells you what happened in the market, but the 24-hour volume tells you how many people were actually involved in making it happen. It's the footprint of the crowd. Let's use Bitcoin as an example to illustrate this perfectly. Say you look at a tracker and it shows Bitcoin has a 24-hour trading volume of $30 billion. That is a massive footprint. It means a full $30 billion worth of Bitcoin changed hands across exchanges in just that single period. That represents massive, real-world participation. It's not just some digital number ticking up or down. It's a literal ocean of capital constantly shifting between real buyers and real sellers. Moving on to part 2, the shopping mall analogy. Sometimes tossing around massive billions can feel a little abstract, right? So we have a brilliantly simple, real-world way to visualize this data. Imagine 2 shopping malls in your city. The first one is high volume, the crowded mall. It's absolutely packed with thousands of people bustling around, actively buying and selling stuff all day long. Now imagine the second one. This is low volume, the empty mall. Just a handful of visitors, echoey hallways, super quiet activity. If you were a business owner, which mall would you trust as a sign of real sustainable consumer demand? The crowded one, obviously. Crypto trading volume works exactly like this. High volume equals real participation and a super lively market. Low volume means a quiet, way less reliable market where even a single purchase can totally distort the perception of demand. Which brings us to part 3, how volume confirms trends. Now, let's get into how we actually apply this. We're going to look at the single biggest reason traders watch volume all day long, to see if a trend is actually confirmed. Guys, this is the golden equation of technical analysis. Price going up, combined with rising volume, creates a stronger, much more reliable move. Let's say Bitcoin jumps from $90,000 to $95,000. If you check the volume bars and see that the volume is shooting up significantly at the exact same time, boom, you have confirmation. It shows strong, totally believable buying pressure. It means the market universally agrees with this new price tag, and a huge crowd of people literally put their money where their mouth is to push it up. But contrast that with this incredibly dangerous scenario. You get an identical price jump, 90,000 up to 95,000, but this time the volume stays completely flat. Or worse, it actually drops. This is a significantly weaker, far less convincing move. Sure, the price moved, but barely anyone was actually involved in making it happen. It's a phantom rally. That specific move could reverse incredibly rapidly because there just isn't a solid floor of buyers supporting that new $95,000 price point. Let's break this down even further in part 4, high volume versus low volume. We really need to explicitly break down the risks and the realities of both extremes on this spectrum. On the high volume side, you have exceptionally strong participation. Because there are so many buyers and sellers active at once, it's incredibly easy to enter and exit trades. But, quick side note here, high volume does not always mean the price is going up. Yes, it appears on massive rallies, but it also appears during panic sell-offs when everyone is rushing for the exit at the exact same time. It just means the move has serious conviction. On the low volume side, you have much weaker participation.
Because the market is so thin, there's a substantially higher risk of sharp, violent price swings. When there are very few people sitting in the order book, a single medium-sized order can rip through the available supply and move the price way, way more than you might expect. And I want to directly tie this back to your personal risk management. This low-volume environment is exactly where beginners need to be the most careful. New projects, meme coins, and low-cap tokens are totally notorious for having incredibly low volume. A developer or a handful of insiders might push the price up 500% using very little money, making the chart look absolutely amazing. But because the volume is so low, the absolute second you try to sell your bags and take a profit, there's nobody on the other side to buy them from you, and the price instantly crashes. Let's clear up a major area of confusion in Part 5, trading volume versus market cap. We have to address the elephant in the room and separate our new tool from one of the most commonly confused metrics in the entire crypto space. If you've been following our deep dives, you know we've talked about market cap before. Let's clearly separate these two once and for all. Market cap is the total overall value of a project. It's literally just the current price multiplied by the circulating supply. Because of that math, market cap usually changes pretty gradually. It's the sheer size of the ship. Trading volume, on the flip side, is just the buying and selling activity over a set window. Think of it as the engine's RPM. Because it just measures daily activity, trading volume can change incredibly rapidly. It can spike 1,000% in a single day based on one crazy news headline, while the market cap barely even twitches. The biggest takeaway here is that neither metric alone tells you the full story. You can easily have a massive, multi-billion-dollar coin that has incredibly weak daily volume, just because all the holders are sitting on their bags and not trading. Conversely, a tiny little microcap coin can suddenly experience a massive volume spike because a famous influencer tweeted about it. This is exactly why expert analysts always look at both metrics together to gauge the true health of any crypto project. All right, picking up the pace, here is Part 6, 5 Common Beginner Mistakes. Let's synthesize everything we've just learned into a rapid-fire, actionable survival guide. Avoid these 5 traps, and you'll literally be ahead of 90% of retail traders out there. Number 1, ignoring volume entirely and just staring at the price chart. We now know that's basically driving blind. Number 2, assuming high volume always equals a bullish upward move. Remember, a massive market crash creates absolutely huge volume as everyone panic sells. Number 3, ignoring liquidity conditions. Volume tells you how much is trading, but liquidity tells you how easy it is to trade without moving the price. Number 4, chasing volume spikes blindly. Don't just jump into a trade because the volume bar is massive. Check if it's driven by real fundamental news or just a temporary flash of hype. And number 5, treating volume as a standalone signal. Volume is an amazing tool, absolutely, but it is not a replacement for fundamental analysis, actual research, and strict risk management. Let's bring it all home in Part 7, Recap and Conclusion. We have covered a tremendous amount of ground today. Let's pull all these clues together as we wrap up this explainer. To summarize your new analytical toolkit, trading volume simply measures the actual amounts being bought and sold. It acts as the ultimate lie detector for a price chart, confirming whether or not a price move actually has real strength behind it. High volume means a crowded mall with strong market participation, giving serious conviction to the trend. Low volume means an empty mall, thinner markets, and a way higher risk for violent price swings. And finally, never forget that volume is the daily pulse of activity, which is completely different from the overall market cap of a project. So, I'm going to leave you with this final thought to ponder. The crypto market is totally designed to test your discipline and your attention to detail. The next time you log in and see a coin pumping on the charts, are you just going to look at the price and get caught up in the illusion? Or are you going to check the volume, look at the actual people behind the move, and uncover the truth? Keep exploring the rest of our Explainer series to master these foundational skills. Stay focused, keep learning, and I'll see you in the next one.